Hi, John. How are you?
I'm good. How are you?
Yeah, very good. Thank you. Look, in our previous videos, we discussed a lot of things such as NOP, leverage, margin, slippage. But now, we received one of the very frequently asked question, which is swap. What does mean swap? How brokers do charge swaps? How the liquidity providers apply swaps to the brokers? So, John, can you please elaborate on this?
Absolutely. So in a simplistic way, right, a swap is a position that you roll over to the next business day. So you keep the position open overnight. Therefore, if we're talking about a currency, is the interest rate differential between one currency and the other.
Okay.
Swaps at an institutional space level basically are charged on a daily basis. And those swaps are coming directly from tier 1 banks, which effectively your LP passes it on to that financial institution. And if that financial institution happens to be a broker-dealer, then they charge their clients accordingly.
So the central banks, they define what is the currency rate and currency interest rate. Then the prime broker take those information into consideration, apply to liquidity providers. Then liquidity providers apply to the broker dealers. And then brokers, they pass those requirements or they charge specific fees to their users.
That's exactly correct.
I see.
So, and don't forget that those swap charges have a tendency to fluctuate from one day to another. One must always be very on the lookout when interest rates vary from one central bank to the other. This is obviously going to have an impact on your swap charge. We also know it as a financing cost because you're essentially transferring a position to the next business day, and therefore that swap fee is applied.
Okay, so for example, I'm a broker. Recently, I made a small search before our Q&A question, and I realized that most of the brokers, they apply 2 times a week swap charges. So why they do so? Why it's not every day? They can't just charge once a week or just every day or just per order. So how they apply those swaps?
So basically what tends to take place, obviously each business model is different. From a liquidity provider standpoint, as long as you roll that position to the next business day, or we call it, if you do a rollover, you're always going to be charged on a daily basis. Now, one thing that is important to keep in mind is that if you open a position today and you close it today, you're not going to be charged a swap. But that trade will settle in 2 business days from today. Now, if you keep a position open for 5 days, you should be applying, or you should be charged 5 days of swaps or rollovers, as also known in the industry. So it depends on what the broker is doing, what type of commercial offer they're giving you, but the standard in the industry, you will be charged daily. Now, when you reach, for example, Thursday or Friday, the institutional space would charge you an additional 2 days for the weekend to roll over that position, whether it's on a Thursday or on a Friday. It varies from liquidity provider one to another. So that's where you probably see an additional charge versus the daily charge of those weekend days.
Okay, so basically the liquidity providers, they charge every day.
Yes.
But when you are a trader, retail trader of the broker, so you see this realized P&L, the profit and loss of every single position, immediately right after you close this position, right? But when you are a broker and you deal with the liquidity provider, how do you see this realized P&L? Basically, you have to wait a couple of days because it's T+2.
So the majority of the currencies are T+2, except for 2 of them that is T+1, the Turkish lira and the dollar Canadian. Those two currencies settle within 1 business day, but the rest are 2 days later. So if you open a trade and you realize $100 as a profit, you will receive that amount in 2 days into your balance.
Wow. But why it's happening like this, John? I don't understand this. What does mean this T plus 2, T plus 1?
So basically, the traditional broker dealers, they use trading platforms that are extremely friendly. So they have like more or less a cash settlement, meaning you will see your P&Ls realized into your platform, into your trading account immediately. It's like an instant settlement. But the institutional world works in a different way. It's 2 days settlements. Very similar concept that to securities. You know, when you buy a security, you're not an owner of that stock
Right.
until 2 days later.
Right.
It's where it all derives. It's a very similar business.
Needs to pass all the clearing stuff, and then it will, this eventually stock become your property.
Correct. But 2 days later, after payment is delivered.
That's why when you sell this security within that day, actually you do the trade, but you never become the owner of that stock.
Effectively, that is correct.
I see. Okay, so thank you very much, John. I think, I hope that it's now a bit more clear. And yeah, guys, we are welcoming any of your questions. Thank you.